I agree. Yeah. Once it's done, I'm not quite there yet, but once it's done, it's done.
I could admit to a little bit of that, but yeah, man, I'm looking forward to part 2 of 3 of these stable coins. That was a lesson last week.
It's a really cool concept, which I think that everyone should understand, at least whether or not you're going to use it. The intermediate stuff is where it starts to get interesting. So that's today.
More of the intermediate stuff. Okay, so for anybody watching, there is a replay. It's in the 100x group. I'm sure I can grab that if you've missed it. And over to you, Scott. Looking forward to this.
All right. Am I good to start?
You're in control, yeah.
Okay. Okay, so today is intermediate stablecoin yield strategies, which sounds really boring, but I'm confident that you'll find it interesting. Because really, this has been the worst bull market ever. Like this bull market has just absolutely sucked in every possible way. You know, this is March. This looked like a very good dip to buy. It looked like we were going to make it. We didn't make it. This one looked like a good dip to buy. We didn't make it. If this one doesn't make it, we got to readjust. So is it a bull market? Just by 4/5 of a fly's foreskin, it's technically still a bull market. If we drop below here, and this is total 3 minus USDT minus USDC, I don't think you can call it a bull market anymore. In fact, I think you can call it a bear market. And if we look at what our FinRev system is holding today, 2 longs in TRX and XRP, and mostly short everything else. So let's get into it. So we're in the process of adding versions of this to our automated system, FinRev. It's just a byproduct of the research that we're doing right now. So it's really nice to be able to share it with you. You can earn from 4% all the way up to about 50% for doing this. But there's some catches that you're probably not going to like. And today we're going to go over some workarounds for some of the things that you're not going to like about this. Let's get the basics straight. Someone might want to borrow your coins. Why would they want to do that? Well, to bring more liquidity to a specific chain. Like, for example, AVAX chain wants to be the Ethereum killer. They want more people using AVAX chain. They will incentivize that chain. The next reason why someone might want to borrow your coins is just to finance leverage. You know, to lend out to someone else. The next way is to take advantage of what's called basis yield, which is the underlying thing which you want to look for here, which is where you get paid for holding. Basis yield is a concept from traditional finance where you get paid to hold a thing. It's analogous to dividends on a share. So remember last cycle, those of you who were here, there were a bunch of private companies like BlockFi, Gemini, Earn, Anchor Protocol, all of those assholes. They were paying money to borrow your coins, but they were basically giving you an IOU. It turned out that shady guys looking like this in crypto, you shouldn't lend money to for any reason at all, let alone on an IOU. All of this, and there's still a bunch of these sort of people around. Nexo is one, based in fucking Romania. If you think that a Romanian company issuing you an IOU is worth 15% they're going to give you, you got rocks in your head. Don't do this. These are all bad, bad, bad. We've got to stick to real yield earning strategies. And remember, this is crypto. You just can't trust anyone. And the yield strategies that make the most sense to me, first of all, are exchanges so big that if they go broke, we're all fucked anyway, so there's no real point in worrying about it, which is really Binance and Bybit. If either of those two go down, we got so many problems. You can just imagine the I told you so's from Elizabeth Warren. It'd just be shrieking from morning to night. So I think you can trust Binance and Bybit, because if you can't trust them, then we've got bigger problems than that anyway. The second category is companies that you actually trust. PayPal has just opened up a stablecoin, which we're going to talk a little bit about. But if Apple or Microsoft or Amazon promise to give me whatever percent yield on my coins, I'd trust Apple, Amazon, Microsoft, PayPal. There's probably a handful of other companies that I'd put in that list. I wouldn't put anything to do with Tesla or Elon Musk or Twitter in that list. And the third category is trustless DeFi primitives, which is what we're mainly looking at, because basically with DeFi, you don't have to take anyone's word that they're trustworthy. Things get, if someone hasn't got the money to pay you back, they get liquidated, their shit gets sold, you get what's left, and the world keeps turning. And we have quite some evidence that the big DeFi players, Aave and Curve, have been through some horrendous things and haven't skipped a beat. So we can have quite a lot of confidence in these trustless DeFi primitives after a couple of bear markets. The last reasonable place to leave your coins for yield, and it's a little bit riskier, is in what's called liquidity pools. So liquidity pools are leaving money with market makers. That could be swap market makers on DEXs, or it could be one of my favorite ones is this one, Hyperliquid. You go to hyperliquid.xyz, go to Vaults, look at their HLP provider, and they have 245 million locked up, and you can see their profit is relatively a straight line. They've earned 11% for the last month. That's gone up as high as 100% a year, and you can see what they're holding in here. You're basically contributing to being a market maker. This is a perfectly good way of earning yield off USDC, by the way. So if you want to do this one, which made 11% last month, but it goes up and down, you go here and you click on connect. It's going to say connect my wallet. I'm going to whack in the password. Actually, I'm not going to do all that now, but yeah, you just deposit to there, and the interest comes out every day. Today's intermediate strategies, the beginner stuff. Quick recap: you can just leave your USDC on Coinbase and get about 4%. You can leave your USD.E on Bybit and get 7.38%. This is actually pretty good for just leaving it on Bybit. PayPal USD is giving you 25% for 30 days only. That's kind of like a teaser rate to get you in, and you can see these rates. There's a list of rates on Bybit. What's that? Probably. Sorry, I'm a bit clumsy today. No, I won't go and do that. But if you log into Bybit, there'll be a list of all these deals and how long they operate for. This is not bad. Like 25% for PayPal USD for 30 days. It ends in 13 days. Do I think that's a good deal? Yeah, I do. Do I think PayPal is going to go broke? Do I think Bybit is going to go broke in the next 30 days? No, I don't. Is the risk zero? No. You're getting paid for assuming a risk. Is that risk a good deal? I think it is. Ultimately, we can expect most of the yield from stablecoins to accrue to the holders of those stablecoins, but just because if they don't, then someone else will come up with a new stablecoin and offer more yields. And then we'll see an Apple stablecoin, which pays you the treasury yield less 50 basis points or something like that, and blah, blah, blah. And the yield goes up and down with two fundamentals. The first fundamental is what can those funds earn in T-bills, which is around 4% currently. And secondly, how much demand is there for leverage? Not much currently. So let's look into USD-E, which is a synthetic stablecoin. You construct USD.E by going simultaneously long Ethereum and short Ethereum futures. So you're betting that Ethereum goes up at the same time as you're betting that Ethereum goes down, and you're collecting the funding rate payments. This is for the last year, and we can see this off velodata.app. You can see it's gone as high as 27%-ish. It's gone as low as 5%-ish. See how wildly this fluctuates around. What do you notice about the times when this is fluctuating around? In the chat, please. What jumps out at you about this? Richard says correlation. Good point. Sushant aligns with bull market. Graham Sellers, price is up. Okay, I think you guys have got the picture here. The time when the yields are actually worth doing, who was interested in staking, who's interested in going to stable coins and staking in March? Almost no one, right? Why? Because it seemed like we were getting rich every single day. Who is interested in stablecoin yields today? I am. I'm really interested in stablecoin yields today. Unfortunately, the yields today suck because no one's interested in leverage. People are interested in leverage when the market's going up. So at the time that these yields are highest, you won't want to take them. And the time when you want yields, like right now, the yields suck. So we're gonna look at this fundamental problem today and how we can fix it. And the obvious way to fix this is by locking in those yields when they're good. We might want to lever those yields up, which means we can borrow against our own stable coins. We could take $100,000 worth of USDC and borrow $200,000 worth of USDE against it, and then stake that $200,000 worth of USDE. And we might get twice the yield, less the borrow cost. And we might want to pay attention to those yields as a signal, because you can see that when these rates top, bull markets tend to top as well. So the takeaways here: the yield goes up with the demand for leverage. Demand for leverage goes up in bull markets. In bear markets, demand for leverage drops. So stablecoin yields are only in play when you don't want them, because you're earning more from trading. Like, it was very, very easy to 10x an account in March. I know 27% per year was not appealing to me in March. I know 27% per year is very appealing to me right now. When you do want it, it ain't there, and that sucks, and that's what we're going to fix that. But first, let's go to fi.woo.org and let's check some yields. So we're going to go to fi.woo.org and we're going to go to earn. Sorry. Let's see what sort of deals these guys have for us today. So we're going to sort by APR, and the best thing they have on offer is 15% on Mantle Ethereum, which is Ethereum on the Mantle chain. AVAX, 13% for holding AVAX on the Avalanche chain. The problem with both of these is that you have to take the risk of AVAX going up or down. So you get 13% for your AVAX, but AVAX has gone down 13% in the last month. Well, that's not a very good deal. So the deals that they have on offer for stable coins, the best deals that we see are 12.8, 10.8, 9.8. Like, these aren't particularly appealing yields right now, and they're on weird chains: Arbitrum, Polygon, Avalanche. Like, they're not things that I've never heard of. Like, I've used all of them, but it's certainly not the Ethereum chain or the Bitcoin chain, right? when the going is good, we can lock in high fixed yields with Pendle.finance. And we can look at basis trades in other coins with Pendle, which is actually really cool. We're going to look at that next week. And next week, we're also going to look at liquidity pools. So let's actually go to Pendle.finance. And what we're going to do is click on Launch App. And now we're going to sort by fixed APY. And we're going to look at the deals that they have on offer. So we can give them USDE for SUSDE, which is staked USDE. For 20 days, we can get 15% per year. And this is a fixed yield. Now, it doesn't mean that you can't get out of it halfway through, but you don't pay a penalty. You have to exit at market rate. So we're going to talk about that a little bit. So let's go through what we would actually do today. So which of these deals looks like the best deal to you guys right now, and why? We've got 15.32% for 20 days. We've got 13% for 48 days. We've got 111 days at 12.97%. Which of those deals would you take? So which of these deals would people take now, and why? Okay. John W. Top deal, short time frame, good rate. The top one. Ren Chateau, first one. Okay, now remember that these rates go up with demand for leverage. Demand for leverage is comparatively low right now. So if someone wants us to lock it in for 100 days, when the demand for leverage is low, that's probably not the best idea for us. The best idea is what most people have said, which is take the 20-day stake when demand for leverage is low. If we were seeing these numbers up around 40 or 50%, and they were 40 or 50% when at one stage, we would want to lock in 100 days at 40 or 50%. Does that make sense to everyone? When you're getting a good deal, you want to lock in that deal for longer. When you're getting a crappy deal, but it's just paying the bills, which is and let's be honest, these are kind of like mediocre deals. No one's getting bonus about 15% a year, but it's better than a kick. It's better than a kick in the nuts, right? All right, so I think we've all agreed we would take this one. How would we do that? So the way that this works is that we swap our SUSDE, which is our staked Athena, our staked USDE, and we swap it for PT USDE. Now, this gives us that there's 78 million bucks worth of people doing this one in particular, right? At maturity in 20 days, we get exactly what they promised. If we want to get out before the 20 days, we have to exit at the market rate, which is down here. And you can see that the market rate has been 4.29% for quite some time, right? Oh, this is 1 hour. Let's look at 1 day. It's still been 4% for a long time, right? But if we go back a while, this market rate up here was 24%. So this light blue line is the line that is the amount that you can exit for right now. So back up here, you can see that at this point in time, back in May, these guys were getting 41%. If they wanted to exit early, they accepted 18%. And so this is the amount that these guys were getting all the way along. And you can see how this has just fallen off a cliff as demand for leverage has gone. Any questions on this so far in the chat? No questions? My advice to you is that you're partially getting paid for the lockup period. The spread is higher when demand is high. Exactly so, Richard. How do you buy the SUSDE? Again, we go app.athena, ETHENA.fi. And you can then put in your USD Tether, USDC, whatever stablecoin you have, and you can buy USDE. Once you get USDE, you go to earn. And we stake our USDE for SUSDE. There's a catch here. They hold it for 7 days after unstaking. That's 7 days that they're holding it for you. It seems like nothing, but you actually do the math on it. It's quite a high fixed cost. It's quite a high fee that they're charging you, because holding your shit for 7 days is like charging you an interest rate on it. If you work out it 7 days doesn't sound like much, but if I said I want to get 1/50th of 1/52nd of 4.4%, it's actually quite a high fee. So this is how they make their money. We take our SUSDE, which is now in our wallet, and you just connect your wallet by clicking connect wallet. We take our SUSDE and we head over to Pendle. And we put our SUSDE, having already got 4% from, we get 4% per year over here. And then we come back to, here and we swap our SUSDE for PTSUSDE. And we do all this on app.pendle.finance. Now, what are the volumes like in these things? Pretty good. Yesterday, there's 30 million bucks going through here. Day before, 10 million bucks. Day before, 13 million bucks. It's not like there's no volume like that. Donna, no, there's no fees for the swap, but there's the hidden fee of the 7 days it takes to unstake ENA, and there's also the spread between getting out early. So they make money when people decide, oh, I want to get out early, I've got to buy this coin, and they unstake and they take a haircut on it. This is like a hidden cost. So my advice is to hold these things through to maturity. Now, one of the things that we're going to be talking about next week is we can then take that PTSUSDE and we can go and deposit that in a liquidity pool. and these and earn let's look at it. Actually, let's look at it on a daily chart. I'll zoom it in. So these have been as high as 40% in the bull market. 52%. If you're getting 52% on a stable coin, that's pretty good. That's actually really good. You should be taking that. Like 50% on a stable coin is much better than 100% with FinRev, actually, because it's going up every single day. It's just a better deal. So let's go through the steps. First of all, we need to get some USD.E. You can either swap for it at app.ethena.fi with Ethena with an E, or you can just buy it on Bybit or Coinbase or wherever. Then you'd lend it through either curve.fi, aave.com, fi.woo.org, or if you want fixed yields, pendle.finance, and you get STUSD.E in return. When the period's over, you click on claim rewards, you swap your tokens back for USDE, and you can go and either go back to Ethena and you can go swap your USDE, swap your USDE back to USD tethers or whatever you want, or you can leave it in USDE. Questions so far? Excellent, Jason. All of this can be done concurrently, yes. So the key things that I want you to take, there's lots of E's and C's. Yeah, it's a pain in the ass. It ties my head in knots a little bit. And you want to be really careful with it. And you want to write down everything that you're doing because you don't want to forget about any of this stuff. It can be big money. So no questions on how this works. The key takeaway is that right now you probably look at 4%, 9%, 7%, 15% and go, oh, that's meh. But at 50%, that starts to look really good. So probably you want to keep track of this, and probably you don't want to do it exactly today. So YT tokens on Pendle are what's called a yield token, where we're going to go in detail with this next week. That's the advanced strategy is to use Pendle for other coins other than USDE and, and stake actual Pendle, but there's an extra step in there and we're going to do that next week. All right. So usually I give a, marketing heavy presentation that my marketing team wrote, but I'm bored with that at the moment. So I'm just going to show you under the hood of how our trading system works. And I'm going to show you the changes that we're making to make it even better. So this is how our trading system works. This is Bitcoin. We have 6 different algorithms. They each make a prediction. Do we think it's going to go up or do we think it's going to go down? And let's look at. So for example, here, it started to think that the market would go up here. We started to become less confident in that. Here, we started to think that the market would go down. Here, we started to think that the market would go up. Here, we'd start to think that the market would go down. Here, we'd start to think that the market would go up. And here we're thinking that the market will go down again. How do you read these numbers? -10 is a normal short position. +10 is a normal long position. +20 is a max long, -20 is a max short. So where are we now? We're about half short. We think that the market's going to go down kind of half. This is how our system works. And we're going to take positions in all of these different coins at once. And so what does that look like? So you log into your FinRev dashboard, and it's set up for you at a specific, what we call a volatility target. Now you can get this to wiggle up or down a lot, like this particular one here, or you can set it to wiggle up or down a little. And you can see that these ones here are set to wiggle up or down a little. These are 35 vol accounts. They don't make as much money in the good times, but they don't get shat on as hard in the bad times. So we have 4 different leverage multipliers volatility targets that we recommend. 35 is fairly conservative for a home trader. 40 is in the middle. 45 is starting to get aggressive. 50 is very aggressive. This one here is 90. So we can turn it up higher again. I wouldn't advocate having your whole stake in 90. And this is what it's looked like for the last 12 months. And this is what it's looked like on individual days. Now, some things that I want to point out to you. See these individual wiggles. When it's hardly doing anything, this sucks for our system. So when it's hardly doing anything, this sucks for our system. When the system starts wiggling a lot, both up and down, you can see that we tend to make a lot more money than when it doesn't wiggle a lot. So we are waiting for our system to start wiggling up and down a lot. This is how it works. So what happens? You connect your Binance, Bybit, DYDX, KuCoin, or BitGet account. All those exchanges are slightly different, and I can't definitively say any of them is better than the other, except for KuCoin. I'm at the point where I can definitively say that KuCoin is worse. And if we look at KuCoin, sorry, it's a bit slow with zooming. Hasn't been good at all. You know, 50, and we're seeing a huge gap between 50 vol and 40 vol, and there's something wrong with that exchange. The way that their market makers work, the liquidity that's available. It's the only one I don't like. The rest are great. The rest are really good. Binance, in general, Binance is best. Bybit is second best. DYDX version 4, we just started, and so far it's outperformed everything. So we're very happy with DYDX version 4. Yeah. So you log into your account. First of all, you see the amount of money that you've deposited in, your current market value, and your profit. As you scroll down, you're going to see your top 10 long and your top 10 short positions. We only have 2 long positions today. Everything else is short. You can go to your portfolio tab. You can sort this alphabetically. You can sort it by longs and shorts. You can see we have 2 longs and everything else short. Or you can sort it my favorite way, by notional value, by seeing what is the biggest positions first. So our biggest positions are long. This is a $90,000 account. It's got about 10% of the account in a TRX long, and everything else is short. So since 2019, what I'm going to show you today, what I've just shown you, what I'm going to keep showing you, has turned a $10,000 starting investment into $203,000. You're going to see a press button make money system that makes money every single year since we started doing this in 2019. It never has a losing year, has 4.5 million of our own money, making 100% per year. It earns risk-adjusted returns better than George Soros and Ray Dalio put together, and that's not a lie. It works in bull markets and in bear markets. It's very important to be able to make money in bear markets, especially in crypto, especially during the SBF FTX. We were really, really proud that we actually printed a profit during all of that stuff. It requires no thinking, no luck, no predictions. It requires zero knowledge of crypto or blockchain. It runs on autopilot. It takes 3 minutes to set up. Doesn't require technical skill. It takes the risk out of crypto because it makes money in bear markets. 4 of the 10 biggest hedge funds in the world use it. It's created countless billionaires and multimillionaires, like John Henry. He's worth $4 billion, owns Liverpool Football Club and the Boston Red Sox. Like this guy, Clifford Asness, he runs $150 billion and he's worth about $2 billion. This is my own personal performance. I've got to update that. I'm in drawdown now. I was up 149% for the year, and now I'm up 100% for the year. So it wiggles around a lot. But it's also based on the oldest and most consistent way of profiting from any market, which is trend following. The trend is your friend. So what is trend following? It's the simple idea that a coin that starts going up has a higher probability of continuing to go up. I have my retirement accounts with my friend Paul Mulvaney. He's just hit it out of the park for me over a long period of time. The gray line is the S&P 500. He's just smashed it for me. I'm very grateful to him. He's taught me a lot about trend following, and he's been since I pivoted to crypto, he's managed my money better than I could. This is an index of every trend following fund which has a track history longer than 10 years. Gray line is the S&P 500. The light blue line is trend following. It's just beaten it. And it's made money not every year. It makes money about 6.5 years out of every 10 over the last 150 years, but it makes money every single decade. Every decade has been positive for over 100 years. And what I'm trying to say is that it's two things. Well, first of all, that trend following is as close to a law of gravity as we have in financial markets. It just works. And it works in stocks, bonds, real estate, FX, and commodities for as long as money's existed. But the second part, the part that I'm glossing over, is that if your car will work like this, you'd shoot the mechanic. Like work doesn't mean set your clock by it. Work means at the end of the decade, it's going to work. Now, this is all sped up with crypto. So instead of saying at the end of the decade, we can say at the end of the year, it all works good. Because crypto is newer, faster, higher risk. Everything works better. We don't have to wait. We don't have to sit through 2-3 year long drawdowns. Like you can see, that was a 4.5 year drawdown here. You don't have to sit through any of that with crypto because it's much faster. It's worked for 10,000 years. Why? Because human nature hasn't changed. It works because the stuff that starts going up, people get greedy about and they keep buying it. Stuff that starts going down, people get scared about and they start selling. We're still greedy. We're still fearful. That's not going to change. The opportunity of our lifetimes is that it works much better in crypto than it ever did in traditional finance. And you can see the blue line is our trading system. The yellow line is Bitcoin. Bitcoin has these wild swings and we don't. And this is what we call the greatest discovery in little guy finance. So let me show you. This is earlier this year when we had the, starting in October until about March, this was the bull market we had. The top performing coin was TIA. Also, top performing coins were Solana and INJ. TIA is this light green line. You can see that way before it broke out, it started outperforming its peers. INJ, same thing, it started outperforming its peers. Solana, same thing, very early. You can see that Solana was leading the race out. And we've got one coin that's leading the race currently, which I'm going to dig into in a moment. And in 2021, the coin, we had two kind of bull markets in 2021. We had this first one, and then we had this second one. So in the first one, the coin that you really wanted to hold was Matic. And second coin that you really wanted to hold was Doge. And then the third coin was maybe Solana. Matic, way early on, you can see it's poking its little head up out here, like way at the start. Doge too, way before Elon started tweeting about it, you can see Doge overtook everything. Solana overtook everything way earlier. This is something that we see again and again. In the second half of the bull market, the standout coin was Sand, which we were in. Why were we in it? We're in it because we saw it break out early, like very, very early. This is the way it works. Now, if we look at how you do this in a practical sense, we're going to look for a market bottom that we think might hold. This was our recent market bottom. So what I'm going to do is I'm going to slide this over until this is at the bottom. And we're going to see which coins are breaking out early. You can see really that this one here, HNT, this second coin, Aave, the red line, these look to be the strongest coins so far in an absolute standout. So if you're holding in your portfolio, the blue line, the dark blue line here is Bitcoin. If you're holding any of these coins, and I'm unfortunately holding one of them, which is at the very bottom, which is underperforming Bitcoin and taking more risk than Bitcoin, I'm taking a sucker deal. I need to swap this out. Swap the weak horse for a stronger horse. Does that make sense? Like we've got a very weak prediction that a coin that starts going up is going to continue to go. So you now possess the ability to know with absolute certainty which coins are going to be the moonshots in the 2024 bull market. I'm red hot on HNT and Aave this cycle. Let me show you how to take all the thinking and the guesswork and the uncertainty and all the skill and the bullshit and the clicking and the clacking out of it. Let's turn it into a system that doubles your money every year on autopilot. I'm not going to give it to you for free. I should have deleted that slide. I'm going to show you today how to automate this thing into a press button money printing machine that you'll learn how to ride this bull market for all it's worth and compound your gains into generational wealth without lifting a finger. So let's say you bought Bitcoin right at the perfect time for $3,700. You would have done pretty well. You would have earned 57% a year, but in the same time, we did 107%. And Bitcoin holders, they deserve every bit of the pain that they go through. They deserve it all because, you bought Bitcoin at 60,000, it dropped in half to 30,000, it went back to 70, and then it went down to 16, and then it's back up to 70, and then down to 58, and then it's 60 today. It's like, it's really hard work. What happens if you want to buy a car or a house or a holiday, or you want to pull your money out? You bought Bitcoin for 70, you're not going to cash it out at 16. Like, let's be a bit realistic here. If you're in our system, things pull back, but only really 10 or 20%. If you bought at the absolute worst time in the last bull market, you've actually quadrupled your money since then. You never had to try and time the exit perfectly, which is incredibly hard. You never experienced a losing year. You never get stuck holding the bag when the bear market hits. If you stuck $10,000 back in 2019, you'd have 380,000 now compared to 110,000 in Bitcoin and 146 in alts. But the point is that you'd be in year 5 and you'd be starting with 10,000, the compounding's really kicked in by year 5. But after year 5, you've got enough confidence that the thing's working, and you can see it's just a couple of more years until we're at year 10. And then we're talking real money, like real money. I don't care who you are. If $10 million isn't enough for you to retire, you probably should adjust your expectations rather than your number. Like, absolutely, there's nothing worth doing that you can't do with 10 million bucks in life. Like, you can't be private jets and private islands and shit like that. But anything where you can grow up, you can do with this kind of money. If you wish you had a time machine like, Marty, we have to go back to 2011 and buy them Bitcoins, this is the next best thing. I've been doing this for a long time. My retirement accounts are, they're about $10 million today. We've been running it on crypto for a couple of years. The results are incredible. We offered it to our best clients during the middle of the bear market while everyone else was taking it in the ass. This is what the bear market looked like for us. We had lots of false starts. Like, we thought it was going to go, and then it fizzled out. And we thought it was going to go, it fizzled out. We thought it was going to go, it fizzled out. And then finally, it went in the wrong direction. It went in the direction we didn't want, but we don't care. As long as we get a trend, we make money. We did 100% during the bear market. We promised to double people's money in a year, and we did. That's net of fees and costs. Every single person who used this system made money. Everybody wins, no exceptions. And I've never heard of anything like this in my life. I've already shown you, like, it's pretty simple to use. You deposit your money into your exchange account. The next day, the system says, okay, we've got $90,000 to play with. Well, we've got $91,000 to play with. We're going to build the perfect portfolio for $91,000. What does that look like? It looks just like this. We're going to put 9,600 in TRX. We're going to put 8,100 in ICP. We're going to and every day it's going to recheck our forecast, which is here. Remember, if our forecast is positive, we're going along. If the forecast is negative, we're betting that it's going to go down. And you can see that our forecast is still positive, but we're not as confident in that as we were a week ago. That's pretty much it. You can see that our forecast was very strong. It was at 19.74, which is almost a maximum of 20. And we've been gradually reducing that forecast, which means we're gradually taking our position size down. If you go to any given day, you can see what we're doing. So on the 5th of yesterday, our position size was position size is wrong. Oh, no, it is right. Our position size was 74,192. Today, our position size $74,192 TRXs, and a TRX is about 10 cents, so that was about 10 grand. We can go through our trade history on any given day and see what we did yesterday. So yesterday, we bought $50 worth of flow. We bought $100 worth of 1-inch. We sold $300 worth of Aptos. We bought tiny amount of this. So you can see that we're buying and selling tiny amounts to maintain our ideal portfolio. The day before, we sold a little bit of everything because the market was going down. The day before, we bought a little bit of everything. But we're just playing around the edges. And you can see there's a full list of everything that we've done. How does this look? In the long term, it looks great. It looks really, really excellent. It's done on average 107% per year after cost. Compounding is what makes it work. On any given day, you're likely to look at it and go, well, it didn't do anything there. So this is the last 12 months from today. 50 vol accounts have done, this is an average of everyone who's got more than five grand in their account. The 50 vol accounts have done an average of 80.2%. The 45 vol accounts have done an average of 75.9%. 40 vol have done an average of 71.6%, and 35 vol have done an average of 57.3%. In the chat, which one do you think is actually the best deal? Okay, Doors says 50, Johnny says W, Black Note says 35, 45. Okay, this is a really good question, right? Everyone looks and says, I want to make the most money. But finance is one of those deals where ain't shit for free. You make the most money at the end of the year, but at one stage, they were up, the 50 vol accounts were up 118%, and then they got down as low as 61%. So they gave back half of the money that they'd won. The best deal is actually the 35, which is quietest. But if we get a bull market, or if we get any kind of extreme price move, the 50 vol outperforms on the way up. You can see that the orange line is consistently outperforming on the way up, but also underperforms on the way down. And this is the catch. And there's no getting away from it, and there's no denying it, and there's no glossing over it. So we may as well tell you it upfront. High returns come with a lot more variability in your account balance. Myself, I trade at 50, I trade at 70, I trade at 90. Myself, I'm comfortable with high risk, high return because I designed the system. I know how it works. I monitor it every single day. I'm not too worried that it's gonna mess up. Can you switch parameters? You can, but not inside the software. I won't let you tune it up and tune it down every day like you're surfing a wave, because you're going to get that wrong. If you go to customer support and say, hey, I got it wrong, I think it's time to take more risk, and they'll say, yeah, sure, it's your money. But we want you to talk to a human first before you do that. So if you, usually I like to people, especially someone like you, Donna, I'd like to, when you want to switch, just shoot me an email personally, scott@scottphillipstrading.com, and if necessary, we can jump on a call and talk through the pros and cons, because it's not as simple as I choose 50, I make more money than 35. You make more money when it's good, and you lose more money when it's bad. It's a double-edged sword. What you really want to do is relax and enjoy the ride, and know that if you can keep your hands off the steering wheel, this is going to make you rich in 5 or 10 years. Doesn't really matter how small a grub stake you start with, as long as you just keep your hands off the steering wheel. If you don't, let me show you a perfect example of keep the hands off the steering wheel. One sec, I'll just load up. Sorry, one second.
Off the steering wheel is such a critical part of trading that I never really understood until I understood it. And from a manual point of view, I'll shut up now.
No, keep talking.
Yeah, it's like there's an eagerness to take trades, isn't there? And it's that like, oh, I take more trades, I make more money. But then I found, my experience was, well, I've taken all these trades, now I've got to manage them. I'm a bit out of my depth. I'm gonna panic. So
Yeah.
having the wheel, taking less trades, wow, it revolutionized things for me.
Well, so this is the perfect example of ignore this. That was he pulled his money out for a couple of days to do something with, and then put it back in. But this guy he put in $82,000 way back in April in the bear market. It just did nothing, with a few little bumps and lumps, and then and here we are, and he's got 151. Next year that'll be 300. The next year it'll be 600. It'll be. This is kind of what you want to do with it. You just want to ignore the day-to-day kind of messing around with it, and just look at it as little as possible. Really, I mean, I watch it every day, but every day it just gives me heartbreak. But at the end of the year, I go, holy crap, we've got real money here. You just want to relax and enjoy the ride. And my goal for you is the ability to do whatever you want, whenever you want, with whoever you want, for as long as you want. And most people use their time to go, use their time to go and buy money with. Like they go to a job and get paid in money. I want you to do the opposite. I want you to use your money to buy the freedom. Yesterday I spent a day in a park with my 4-year-old, and we went and found the best cookie that we could find, and we found the best playground that we could find, and we got on a ferry boat and went to the playground, and I spent the day hanging out with my daughter in a park. I don't even have my phone with. Like that kind of stuff is what I want for you. That is more important and more, my opinion, that kind of stuff is better than any sort of like I'm flying first class, flexing my Rolex kind of stuff. But you do you. So for yeah, I should always maintain an attitude of gratitude with people who've trusted us, supported our company, supported our products as we've got better and better and better and better. We've been doing this a long time. It is really the honor of my life to grind like an animal for this community, and we are getting to generational wealth. And I've got one more thing to show you. We think we can double it. So how much faster would doubling those returns get you to your freedom number? So if you start off with 10,000 by year one, the blue is 100% per year, the red is 200% per year. You're at 20 and 30. By year two, we're at 40 and 90. By year three, we're at 80 and 270, and the numbers don't make sense after that. So the rate of compound is a very big deal. And so the secret that I've learned from the really big algo trading firms like Rentec, Jane Street, SIG, Susquehanna Group, they blend multiple systems together. This is how it's done. And the idea is that, you know, trend following is great. But you know what would be great is if it did a little bit more of this and a little bit less of this, right? I think everyone should agree that that smoother is better. And so this is what we're working on. We're working on a sprint to make the biggest series of improvements since we launched the system. We finished onboarding DYDX version 4, which has been a massive success. We finished that a bit over a month ago, and now we're working on these huge improvements. So let's go through them. So what we did is we measured how well the performance of all of our individual systems, and these are our individual systems, predict next month performance over different look back links. And this is at 1 month, 2 months, 3 months, 4 months, 5 months, 6 months, 7 months. You can see 7 months is the peak. Anywhere between 5 and 7 is good. So we chose 6 months. And so what we're doing is we're allocating capital to our individual systems. And let me show you how this works. Based on the Sharpe ratio of this individual system. So for example, here in Bitcoin, normalized momentum has a Sharpe ratio of 1.72 since it started, whereas moving average crossovers have a lower Sharpe ratio of 1.48. We're going to give more weight to the signal that performs best. And we're going to update that. Right now, we update it every week. We're going to change that to updating it every day. Now, Bitcoin itself goes through periods of performing really well and performing really badly in our system. As it performs really well, it gets more weight. So it's got 7% of the weight in this system right now. That might go down. So the first thing that we're doing is changing it to a rolling window correlation, recalculating it every day instead of every week. That should be a pretty significant boost. Now, this is 1 day, 2 days, 3 days, 4 days, 5 days, 6 days, 7 days, 8 days, 9 days, 10 days, 11 days, 12 days. And this is our correlation of our forecast with next day returns. So what we're saying basically is how well do our predictions work? If our predictions are better than 0, it means that we're better than a coin flip. So you can see that until about 2 weeks out, we're better than a coin flip. This is a very, very big advantage of trend. We found doing our recent research that we can what's called vol normalize our features. What this means is that we're applying a penalty to a tiny shitcoin that wiggles around a lot. We know that our trend features, this is splitting all of our trend features up into 10 buckets. These are the lowest volatility the coins that wiggle the least, which is Bitcoin and Ethereum. These are the coins that wiggle the most, which are meme coins. You can see that trend following works much better on Ethereum and Bitcoin and Solana and things that wiggle the least, and doesn't work at all. In fact, it's a negative for the coins that wiggle the most, which are meme coins. This is a correlation with total returns by carry feature type. So carry is the next biggest thing that we can add to the system. 1 day cross-sectional carry is predicting about 23% of the next day returns compared to about 3% for trend. So it's better than trend by a long way, but that's not the whole story because it costs a lot more to execute. So it's a wash. 3 day cross-sectional carry is the sweet spot, which is predicting about the same as trend after costs. So it's a little bit worse than trend after costs, but it works when trend doesn't. And so this is what carry looks like with overestimating cost. We're looking at about a Sharpe of 1.27%, a Sharpe of 1.27 compared to 1.7 for trend following. So it's not quite as good, but it tends to work when trend doesn't. I can't explain that easily enough in the time we have. So what we do is we blend them together, and it looks a lot better when we blend it together. We go from we go from 100% to 200% basically, depending on how you blend it. These are our underwater plots. So these are our historical drawdowns. The red dotted line is the average drawdown, which is a bit under 10%, which is a normal drawdown. Our drawdowns have topped out a little bit over 20% in the real world. And that's over, the 5 years we've been doing this now. It's about as bad as it gets. Okay, we have a new edge which we've discovered, which is this thing called cumulative volume delta. Let me show it to you. So cumulative volume delta is, you can get it from CoinWise, is the aggression imbalance. So these are this is the volume traded by hitting market buy divided by the volume traded by hitting market sell. And you can see that when this goes up, when this starts going down, we have a strong signal that the market is going down. When this starts going up, we have a reasonable signal that the market is going up. You can see it's still going down, which doesn't look good for the markets, right? But we've turned this into an extra system for our trend following system. So we're plugging in 6 different systems at once to this. So instead of having one system, which is trend following, we're going to have 7. And this is what a 2-day aggression imbalance looks like. You can see it's like the dream equity curve. It's steady and smooth. It's not as good as trend, but you can see it smooths the bumps out of trend out. And it looks a little worse on the top 50. One of the challenging things with this new system is that it works better on the dog shit coins, whereas trend works better on the coins that aren't dog shit. So if we blend them together, we'll probably have something pretty reasonable. So what we're doing right now is we're adding cross-sectional momentum. So cross-sectional momentum is going long the coins that are going up the most right now, while we go short the coins that are going down the most right now. So we're not taking a directional view on the market at all. Our trend following system takes a directional view. So right now, our trend following system takes the view that we should be mostly short because the market's going down. Cross-sectional momentum doesn't take that view at all. Cross-sectional carry is the same thing with funding rates. It does not take any view at all on the market. we've discovered as part of our research into cross-sectional carry 2 additional systems. One is called premium, which is how funding rates are derived, which is like a forward-looking carry. And the next is that change in premium. And open interest conditional on aggression also looks pretty good. And trend following adjusted for size on the small coins outside the top 50 also looks pretty good. So anyway, so we're on a sprint to do a lot of really, really cool things right now. This is about creating generational wealth from crypto. The idea is it's just compound interest, guys. Like if you earn 100% per year, it doesn't matter what you start with, you're going to end up with a big number. If you even earn half of that, doesn't matter what you start with, you're going to end up with a big number after 10 years. We're in this for the long term. I've been doing this 12 years now, and it's made me wealthy enough that, you know, my family's lifetime financial needs are met. Carry is not quite as good as trend, but it's the perfect thing to blend with trend. So it's sharp 1.17, 53% a year. But when we combine them together, we get 243%. Now, 243% with 35% drawdowns, I don't think most of you are going to be able to handle. I would tone this down and recommend toning it down to about 180 to 200% is the sweet spot. And we build obviously a custom system for you. We can build the soup of the elements exactly the way that you would like it. We can dial your risk up or down to suit your goals. If you're really behind in your financial goals, you have to take some more risk and you have to put up with some more drawdowns. We can help you with that. If you are way ahead of your financial goals, if everything's on track, it's smooth sailing to retirement, I would want you to take less risk. As you're getting closer and closer to retirement, I would take less risk. You need more ballast in the boat the closer you get to retirement, because if the boat tips over and you're 65 years old, there's no do-overs. You've got real problems. So you have to take less risk the closer you get to retirement. And we do this, we've got a whole process we go through. But this is really the difference between retiring at 40 when you can actually enjoy your money and retiring at 50. Because this has been life-changing for me and my family. I want to give you the deal of a lifetime. This is me, this is my little kid, and this is my beautiful wife. And this is on the banks of the Noosa River, which is, one of my favorite spots in the world. We got 3 tiers of FinRev available for you today. FinRev Silver, which is $1,000. FinRev Gold, which is $6,500 for 3 years of fully automated trend following trading. It's everything that I've shown you today has been all on FinRev Gold. FinRev Platinum has a couple of advantages. It's $9,500 for 3 years. Why do we do 3 years? Because you need to do it for 3 years to really let it play out. It's not the kind of thing you want to be in this month, out next month. But this is with all of our systems, including future upgrades and the ability to run multiple exchanges. So multiple exchanges and multiple volatility targets. So for example, I get about 12 million bucks total in my trading accounts, and no, I'm not showing that now, but I have about $90,000 in an account that's at 90 vol, which is an irresponsibly high volatility target, but $90,000 isn't that much to me, so I'm happy to roll the dice on that. So what that lets you do is take some of your bankroll and be very aggressive with it and leave most of it safely compounded. So as our FinRev Gold at $6,500 for 3 years, you get 3 years of automated algorithmic trading. You get a VIP onboarding with one of our expert crypto trader coaches. You get all the stats and monitoring that I've showed you. You can delay starting or pause at any time. Let's say that you notice that my favorite coin, Retardio, is down, breaking my heart, from 14 cents down to 3 cents. And you think, well, shit, that's a slam dunk. If it comes back, I'm golden. I'm going to pause, throw my money into Retardio. When it gets to 10 cents, I'm going to pull it back out, shove it in FinRev. You can do that. Actually, I support that. And we've got our double your money guarantee. If you aren't in profit after your first 12 months using the system, we'll let you use it for free until you've doubled your money. I'm willing to go a little further than that here. And I haven't announced it, but for everyone who buys this week, if you haven't made money in a year, we'll give you your money back. I don't think I can be fairer than that. You know, I guarantee that if you stick with it for a year, you'll have made money. and you get that from finrev.trade/call. Sorry, Ian, for springing that on you. I just got a little bit excited. I know you and Caroline are going to be pissed at me. You should let them know in advance if you're going to offer any new deals. Just like I just blurted it out. So there's a better than normal deal for the next year. FinRev Platinum is 9,500 for 3 years. It's exactly the same thing, except with all of our systems. So the cross-sectional carry, the CVD, cross-sectional premium, all the other ones that we talked about, you're grandfathered into new systems, all 6 of them for no extra charge, same delay, starting or pause at any time. Trend following and cross-sectional carry, smooth it and make it faster. And the same W money guarantee. If you aren't in profit after your first 12 months, you can either use it free until you've doubled your money, or you can just get a refund. FinRev.trade/call. How to get access. If you need if you want a longer commitment, a shorter commitment, payment plan, whatever, just discuss with the enrollment staff. It's not a high pressure thing. It's just an onboarding chat. If you're an existing customer, you want to upgrade, we support that. Yeah, I'm going to hand it back to Ian and take some questions.
Hi, lovely jubbly. So you've been addressing pretty much most of the questions as they've been popping up. Somebody was asking about the next AMA. So I've already answered this, and I said literally we're in touching distance of the next time we're going to get yourself and the devs.
I got something really cool that I can probably share today. The workshop that we did with James, we've got like all the work that I'm talking about here, we actually did on in person together. We flew everyone in. We've got some edited videos on that. I should share those in the next couple of days.
But probably with a warning that they're going to be nerd-tastic.
Oh, dude.
You know,
one of them was like too nerdy for me. It was like fuck off. It was fuck off nerdy.
Yeah. So, including myself, it's usually better to wait a little bit and have the filtered version in the AMA where you don't have to look at odd people talking about odd things.
Oh, fucking James is a physics PhD, and Jack has a Isan boy that he is. He has a master's degree in mathematics, like all you Isan folk do. Yeah, and it was
never does get to 0, but
and
yeah.
Fucking Timon does maths problems in his spare time for fun. That's like his idea of fun. So yeah, it got a little bit too nerdy even for me. So
then this is what makes this just so unbelievably fascinating for somebody like me, and just this approach with FinRev. I mean, you're talking about, as qualified as you can get in mathematics, people sat in a room theoretically mathematicianing. Wow. Now, this is why I don't try and decode the FinRev algorithm. I don't look at it today and say, well, it's doing this today because of this, because it's not. It is so advanced and so beyond anything that we normally do that it's just like,
well, it's not really. These are simple concepts, but they're building blocks. The question is, is this thing predictive? Is this thing that we know now predictive of this other thing that's happening in the future? We think it's predictive, then we should bet that way. If we're taking bets that we think are going to pay off over time, if we take enough bets, we're going to be fine. The guy on the eye in the sky at the Bellagio Casino is not going, oh my God, Ian's walked in. Oh, he's putting it on. No, not red, bro. No, don't put it on red. They're not like that. They just know if you have an edge and you take enough bets, then you win. If you give it long enough. And this is pretty much what we do. So it's the way I trade. It's got 90% of my net wealth in it. If it doesn't work, I'm fucked. So
yeah. I mean, it's good. I would say about this as well.
If it doesn't work, you'll find me eating out of a garbage bin somewhere. But I think it works.
All right, so let's have a quick, I just have a double check. I think we're getting lots any really new questions coming in. I think probably the last thing for me is anybody that's already got FinRev that's on the call. We've done this video and documentation that goes along with volatility. It's when Scott hosted a call with the coaches. That's in the welcome post inside the FinRev group. Just have a scroll and you'll find it. And that will really give you that more of an insight of what to do with volatility. And as Scott says, you come through to the support, you speak with a coach, and we will say to you, you realize you're going over 50% because, it hurts. It goes up fast, but it comes down fast.
Would you like, I can dig into that? I got time, or am I just going to bore people?
I'm thinking that we don't really want it at the nerdy level. It's at the this is when it will hurt you type of level. Because
right. Let's have a look.
It's the drawdowns, myself included. I'm not worried about drawdowns. Then the drawdowns come along and you're like, well, Scott, I don't like this. This hurts me, Scott. This is hurting my feelings every day, Scott.
Yeah, not like that, like this, like this, like this. Okay.
Exactly, I thought we were friends. Be gentle.
Okay, so let's Google Kelly criterion. Here we go. Okay, so there is you can see this right here.
Yeah.
The slope of this line, if it was a straight line, is your Sharpe ratio. The better your system, the better your Sharpe ratio, steeper the line. If we get up to a certain volatility target, and for our system right now, this is about 50. If you go past 50, over time, we would expect to make less money. But in the short term, you can make a lot more money. So for example, let me show you what happens when sorry, it's a bit clumsy here. So let me show you 100 volt. So 100 volt, this guy put in $225 and he's got 14,000. He got as high as 20,000 odd and as low as 11,000. And here he is today back at 14,000. So at 100 volt, if you get a bull market, you can turn $200 into 20,000. If you don't get a strong and consistent trend, that isn't going to be the case at all. So 100 volt is way past here. Beyond a certain point, you're expecting on average to go broke, and you have to be lucky just not to go broke. This point is about 120. We won't let anyone go to 120. I'll let people put part of their account in. It's not my money, but before, so I'm not going to tell you what to do with your own money, but I want you to understand. So if you come to me and tell me that you want to put it past anywhere over here, we're going to have a little chat. What is this point here? It is your Sharpe ratio. Your Sharpe ratio squared divided by 2. So our Sharpe ratio is 1.7. What's 1.7 times 1.7 divided by 2? Someone? Okay, I see. We're all in numeric. 1.7 squared is 2.89. Divided by 2. So if our Sharpe ratio holds at 1.7, the peak of this curve is 144%. The problem is that our Sharpe ratio is not going to stay at 1.7. In the good times, it's going to be much higher. It's going to be 2.5. In the bad times, it's going to be much lower. It's going to be 0.5. So you have to leave a very big margin for error. So if our optimal Kelly at Sharpe 1.7 is 144%, typically you divide it by 2 and divide it by 2 again, and so that gets us to about 36, which is about where we start on the recommended scale. Does that make sense? I'm sorry, I got way too nerdy there. I know.
I thought that was really very good at that level, because
Awesome.
you know, I started in NFTs, so I came into crypto with a very aggressive, stupid, degen, you know, just give me
you want to tell the fucking truth, man.
I am degen.
NFTs on ADA chain.
I got a few on Sol. I haven't got any on the ADA chain. I can say I didn't go down that route, but I was a degen, so I'd hear something like this and I'd be like, well, I want to max this out all the way. But a little bit of education, understanding a bit more about trend following, and you've just done the math there, around that kind of 36, 37 or 40%. That's somewhere around the sweet spot. I've got mine at 100, 90 and 50. So I'm still aggressive even on my shorter one. I suppose with the 30s, because I mean, I'm imagining this beach ball effect that you talked about in your recent emails of where crypto is now, and this blast off that we're going to get. So these 100 accounts, these 90 accounts, they are going to go unbelievably big. But it's just that thing of, I am fully aware that when they go up fast, they also come down fast. But something like that 30 that you've talked about, it's a bit more of a steady drive. It's a bit, this is all right. This is like driving in the country.
But we have a good question here. What percentage are you allotting out of 100% for drawdowns? So at 45 vol, the maximum drawdown we've experienced to date is 22%. And we've had 3 drawdowns of around 20%. Now, something that needs to be said when you're talking about drawdowns is, what's the biggest drawdown you've ever had? Anyone in the chat? Anyone know what the biggest drawdown you've ever had?
There's going to be something else to this question.
Biggest drawdown that you've ever had, that you're ever going to have, is the one that you haven't had yet.
We go.
It's like that darkest day so far. This is the darkest day in crypto, darkest day so far. So, so the fact that we've had 20% drawdowns at 45 volt, one day you're going to get a bigger drawdown than that. One day you just are.
But then if we take, say, today, Scott, and I look at my spot bags that are just down versus my FinRev that, all right, it's not, hasn't been making me the money in this sideways period, but I'm not wrecked like my spot.
I'm still intact. I think 20%, 20 to 22 at 45 vol is about right, Richard. There's 2 types of drawdowns. There's the slow bleed ones, and there's the ones where it's just a bucking bronco. I'm not so worried about a 25% drawdown when I've just 10x my account. Like that doesn't give me any grief at all. I am worried about a 20% drawdown that lasts 6 months, that just every day is, oh, fuck. Oh, you'll find that a 15% 6-month drawdown is much worse than a 30% 3-week drawdown. The death by 1,000 cuts is real, son. It hurts.
It is.
That's why we get paid, by the way. Like, you don't like anyone telling you, oh, it's just free money in crypto. Like, the fuck, it's free money. Like, we work for these bags, right? Like, like this shit ain't free. Like, you can either get paid for doing intellectually difficult things or emotionally difficult things. It's easy. You can have balls or brains. And I'm not that smart.
Yes.
All right, that's about it.
That is awesome. Thank you so much. I'll see everybody in the group. Have a great weekend. Nice one, Scott.